Hi, welcome to my second video podcast slash post. If you've just seen the video, if you go to my website, www.russell-clark.com, you can get written materials as well, if that's what you like. Today I'm talking about JGBs. JGBs, for me, have an endless fascination. If you don't know what a JGB is, I don't know what you're doing on this presentation, but just in case, a JGB is a Japanese government bond. And what I find endlessly fascinating about JGBs is that, for years they were ridiculed as, the worst possible investment anyone could have, and yet in every financial crisis that's come along, JGBs unhedged in dollar terms have been a fantastic investment. And so they're sort of almost seen as a safe haven asset. So what's unusual this year is that we've started to see a long end of the JGB curve be very weak, even as equity markets have also been weak. So why is that, and what does that mean? And let's try and look at that a little bit more. And that's what this presentation hopes to achieve. So when we look at Japan, it is very different to the States. What you see in Japan is the last released inflation print was sub 1% at 0.8. And when we look at the 10-year bond yields, they stay roughly around zero, which is exactly where the Bank of Japan wishes them to remain. The Bank of Japan does not really heavily participate in the very long end of the curve. So that's the 30-year JGBs. They really do a lot more in the 20-year and lower type area. And what we can see is when we look at 30-year JGBs, they have broken out to the highest level since 2016. 2016 is when basically Kuroda did QQQQE, or no, I think QQE he called it, where they massively increased the amount of bonds they were going to buy. They also brought in things like yield curve control and other things, basically, to try and keep the yen very weak. And what we see now is that yields have really at that long end broken out to a very high level. And what is unusual about this is it's happening in a period when Japanese equities are actually relatively, well, like US equities, starting off the year relatively poor. So it's intriguing, why we're getting a very changed relationship a little bit there. Why is that? What does it mean? And how do we deal with that? Let me talk about that next. So one of the things you should be concerned about if you're a global investor is that the long end of the Japanese yield curve, of course, reflects what expectations of central banks are going to do, or what inflation is going to do, and then how central banks react to it. Now, ever since the bubble economy burst and Japanese bond yields have been low, they've always wanted to try and normalize interest rates in Japan. So when we look at normalization, what we try and do is look at what markets think interest rates will be normalized. So we take 3-month TIBOR, which is a Tokyo interbank rate, overnight rate. You can see in the sort of 97, they thought rates, interest rate policy might rise, and we saw TIBOR spike a bit, and then immediately we had the Asian financial crisis. And then rates were cut and slashed again as Asia went through its problems. And then during the dot-com bubble, when growth sort of boomed in the late 90s, again, they thought interest rates might normalize. They went up again, and again, we had the dot-com bust as liquidity was pulled from the market. And then from sort of, 01 through to 05, 06, TIBOR rates stayed very low. And then again, when they thought inflation was coming, TIBOR rates rallied, or sold off, however you want to talk about it. And of course, we then had the GFC, and then Euro crisis followed that. And then TIBOR rates have just collapsed ever since and stayed very low. So if you were a subscriber to a view that I've publicized often of Japan as like the Saudi Arabia of savings, and the BOJ being the sort of the big tap for liquidity of global assets, if you looked at this TIBOR rate TIBOR just continually falling over the last few years, over the last 10 years, 10 years plus, and then you've just wanted to be long liquidity driven assets. And that was probably being correct actually on how you would structure that. So when we see the 30-year JGB starting to sell off, is that a sign that market is seeing, what that liquidity is going to be pulled and equities are really beginning to react to that? And is this a sign to be super bearish asset markets? Potentially, certainly, it's something that's been the case previously. There are, however, I think some big differences now to what we've seen over the last 30 years. And I'm going to talk about that now as well. So one of the big differences, and I've talked about this a couple of times, is that if we look at farmland, I like looking at farmland. Farmland in Japan is a bit different to farmland in the US. So often farmland in Japan is never going to be that far from a train station or a city because it's a small country with great infrastructure. So the gap between farmland and city land or residential land in Japan is less, in my view. Maybe suburban land rather than city central land. In the States, of course, it's very distinct. You definitely wouldn't pay anything similar to what you pay in Ohio, to what you pay maybe in New Jersey. They work very different dynamics. And what we can see here is, what I try to do is normalize for size and for currency. What you can see in the late 90s when the Japanese bubble economy was at full throttle was Japanese farmland was 5-6 times the price of US farmland. Now what's happened since is US farmland has continued to appreciate. Japanese farmland in dollar terms has fallen quite a long way, particularly in the last decade or so. And so you now have a discount to Japanese farmland versus US farmland. Now this is very strange, very strange, because Japan imports its food. So you have a natural upward tendency to Japanese food prices over US food prices. So the implication that Japanese farmland is now cheap seems very odd. Either implies the yen is too weak, farmland is too weak, or some other aberration. And certainly I'm very intrigued by the opportunities that could be afforded in Japanese farmland. Difficult to invest in as a foreigner, but it certainly for me is a big change over the conditions that have prevailed since the bubble economy burst. One of the other big changes we've seen over the last 15-20 years in Japan is that it's become not that expensive relative to the rest of Asia. There's lots of different ways of measuring that, but what we've done here is just taken GDP per capita relative to Asia GDP per capita. Now, Japanese GDP per capita has flatlined since sort of 1990 onwards, and Asian GDP per capita has been dominated by rising Chinese GDP per capita, of course, being the largest nation in the world, but what that has led to is that back in the 90s, Japanese property was the most expensive property in the world and much more expensive than the rest of Asia. Now, property in like Hong Kong, Korea, Singapore, the big cities of China would all be, on a par with Japanese property prices. And so what you gain, and also, high-end wages and high-end jobs have also risen in all those countries. And so the gap between Japanese GDP per capita and Asian GDP per capita has fallen dramatically, particularly in the big cities. And so you don't have this natural downward pressure on asset prices and wages in Japan that you did. And so the inflationary pressure in Japan, to me, looks a bit less. Now, Japanese policy since the sort of bubble economy burst is to try to keep the yen weak and weak as possible. And generally it's failed. So it hasn't been able to really get it weak against the dollar or weak against other Asian currencies. The Asian financial crisis is a good example of that. But what has happened is China is now the biggest trade partner for Japan, almost as big as the States. And the Japanese have been able to weaken the yen substantially versus the yuan. And so, one of the ways I look at this is like if the Asian financial crisis was to repeat, the yuan would depreciate, the yen would rise in real terms, and then that would be the sort of new financial crisis, and that would be in line what we've seen over the last sort of 30 years in Japan. Now, the the thing about that, and that is certainly what I used to believe around the sort of 2015, 2016 period, but some of the data now is sort of pointing the other way. I'll show that. So what normally happens with Japan is when they depreciate the yen, they become too competitive and they start to cause trade surpluses in their partner trade partner countries to fall, which then puts pressure on the exchange rate. Now, when I look at the Chinese, and so if you go back to 15, 16, 17, you can see the Chinese trade balance was falling, and so a very negative sign for that currency. And so the sort of classic Japanese experience of yen appreciation in real terms, followed by JGB yields going to new lows, and deflation returning, which would be my base case. Now, what we're seeing is the Chinese trade balance is surging, new all-time highs, just as Japan looks very cheap, both on land basis, on a GDP per capita basis, and sort of a lot of different measures. So you now have this environment where, I feel like something has to give. Japanese land values look too cheap, given where yen is. Yen is cheap, so maybe the yen has to appreciate. But if the yen doesn't appreciate, then you're going to have inflation, as I think land value trends begin to reverse in Japan. So for me, the current environment is suggesting, particularly if the Chinese yuan continues to appreciate, inflation is coming back to Japan. If that's the case, then JGBs will continue to sell off. And here is where it gets very interesting. Even if Japan is returning to inflation and they pull liquidity, what is that going to do to liquidity-driven assets globally? Now, the history says it'd be very poor. Now, where it gets interesting is I think liquidity-driven assets, equity markets, certainly in the States. Is that true in emerging markets? Is that true in China? I don't know. But we're in a very interesting dynamic, and the JGB yields are beginning to show that change is coming. Something is changing. As long as the yen stays weak, maybe it's just the interest rate market and speculative assets that become problematic. But there's something definitely going on. And I would like to give you a much clearer conclusion, but as I've sort of been pointing out for the last year or so, it's politics that's really driving markets. And politics is by nature a little bit more unclear. But what I'm trying to say to you is something is changing. So be very aware and be very alert to changes in asset markets and what that could potentially mean. All right. Thank you for your time.